and welcome to another edition of Mortgage Chicks with Hot Tips. My name is Cindy Walker.
I'm Kim Hairstead.
I'm Elizabeth Hull.
And I'm Stacy Van Skank.
On this week's episode, we're going over adjustable rate mortgages and home equity lines. We would just kind of like to give you a brief education on what they both are, kind of how they're structured, because we're feeling like these might be popular coming up with the interest rates kind of on the increase. Adjustable rate mortgages are going to probably come back into play, and we just wanted to kind of give you a brush up on how they work. And with adjustable rate mortgages, there are 1 year adjustable rates. We call them 1 year ARMs, 3 year ARM, 5 year ARM, 7 year and 10 year ARMs. It just depends on how long you're planning on being in the home, because if you think this is just going to be a home that you're only going to live in for 3 to 5 years, then a 3 year or a 5 year ARM might be the way that you'd want to go. And the way that these work is, like, for example, a 1 year adjustable rate mortgage, it will adjust every 1 year on the anniversary date. And the way that they figure this adjustment is they add, we'll get into detail about that a little bit later, but they add the margin to the index to determine the interest rate. This means the interest rates can't go up or down any more than 2% per year, because there's a 2% cap on those, and there's a 6% cap on the life of the loan. So the rates can never go up or down any more than 2%, and over the life of the loan, they can never go up or down any more than 6%.
Indexes that we use for those are the 1 year LIBOR and the 1 year Treasury bill. And so that's what determines the part that adjusts. Your margin stays the same throughout the time of the loan, but the 1 year LIBOR and the T-bill are adjustable, and we know they adjust every month, up and down. But it only allows, depending on what you have, 1, 3, 5 year ARM, that's when they adjust. They only adjust monthly if you're doing a home equity line.
Correct.
Right. The adjustment on the anniversary date in these cases is determined by taking the 1 year T-bill plus the margin. On these programs, the margin is 3.75. So if these loans were to adjust now, the interest rate would be the T-bill plus 3.23% plus the margin of 3.75. So that equals 6.98. However, as Cindy mentioned, a lot of these products have caps. So if it can only go up 2%, in this case, it would be capped at 5.2. So, it's not like they can go willy-nilly. You want to make sure that you understand the kind of adjustable mortgage and that there are some kind of caps. Stacy, you want to explain a little bit more?
Yeah, everyone's asking right now, what are the interest rates? Because people feel like the interest rates are high, which is kind of a nick in my craw. Rates are in the 6s right now. I think that's still a really good rate. But if people want to qualify because it's going to be short term in their house, and not even short term, it could be up to 10 years, what are the rates going to be? So I looked up the rates yesterday, and the current rates for like a 1 year ARM was 3.25% with 1 point. So you're going to pay 1% of the loan amount plus 3.25 for 1 year. Then after that year anniversary, it'll adjust. The interest rates for the 3 year ARM was 4%, and the 5 year ARM was 4.25%. And then the other thing people have to understand too, if they want to get an adjustable rate mortgage, we're going to lend up to 90% of the appraised value or sales price, whichever is less. So people that want to get ARM loans, it's not maximum financing. It's not 100%, 96.5%. It's 90%, 10% of the sales price. That's something good, that everyone needs to know. And then there's also something called interest only, where people will qualify for interest only of their mortgage payment. They don't care because property values are growing, and so they're just going to pay the interest because they know they're going to make up the equity on their own. Those adjustable rate mortgages typically have an increase in the interest rate of about 0.25 or 0.25%. So it's not going to be the 3.25 or the 4% I said earlier. It's about 0.25% higher.
Yeah, and while we're on the subject, I'm going to just kind of go ahead and parlay into home equity line of credits, because they are adjustable rate mortgages. Home equity line of credits are second mortgages, And we've been having a lot of interest in those lately because we were doing a lot of refinances over the past 2 years. Now people have good low interest rates on their first mortgages, so they're not wanting to touch those, but they're still wanting to pull equity out of their properties. So this is a way that you can do it by just doing a second mortgage home equity line. But these are adjustable rate mortgages, so you have to keep that in mind. They're kind of like a credit card where the interest can adjust monthly on these home equity line of credits, and you can pay minimum payment, which would be only interest only. But I don't encourage people to do that because then you're never paying down the principal balance.
So yeah, interest rates on a home equity loan, they are attractive and they work well, but they do adjust monthly. So you have to be very, very careful of how you work with your home equity lines. And you can use the money, put it back. Most of the loans that we have that we broker out, you have to take the money out for 90 days. And then after the 90 days, you can put the money back in. So they want to have a couple of payments, before you do that. But then you don't have to have any of the money out at all. You can just,
Nice, so it's just there when you need
just
it.
there when you need it for an emergency.
Mm-hmm.
And it does adjust monthly though. So it's a little bit riskier than, like a fixed arm rate that would be fixed for 3 or 5 years.
Well, and here at Van Dyke, we typically specialize in first mortgages, fixed rates, but we do have the ability to broker out for HELOCs and second mortgages to be able to help some of our customers. So please, reach out, see what we can do.
I've had a couple of home equity loans, and I'm not going to kibosh them. I'm going to talk about the pros and cons.
Yeah.
But something to remember with these, there's always a teaser rate.
Yes.
And that teaser rate,
The
the
first.
last one I got, the teaser rate was 1.99% for the first 12 months. After that, like Kim was saying, it was adjusting monthly.
Mhm.
So it went from 1.99 to like 8. And I also told myself, well, I'm going to make the full payment, the principal and interest payment. I'm not going to make the interest only payment.
Mm-hmm.
So what did I do? Started making the interest only payments. I never really paid it down.
Right.
Yeah.
So, what I try to tell the customers is, be really careful. Let's talk about it. Do you need 10,000? Do you need 20,000? Definitely get a home equity line of credit. And there is a prepayment penalty. It's $500.
Mm-hmm.
If you were to pay off what you've withdrawn, then you just let it sit. You just don't close the account.
Right.
Just because you pay it down to a zero balance doesn't mean you have to pay a penalty. But I did that every time. Both times I had it, I closed them early, paid the $500 fine, but I really never paid it down like I should. So when I talk to my clients, I'm talking to them about, let's talk about a home equity line of credit or a cash out refinance and look at the two.
Mm-hmm.
Because, the HELOCs, they have, a combined loan to value typically of like 89.9%. The credit score criteria, I think, is higher than a conforming. Kim,
Oh
we
yeah,
do a lot of
typically it's like
HELOCs, right?
680 or.
Yeah, they have to have 680
A
in order.
680 credit
Yeah.
score.
And there are
so-
HE loans too, which are fixed in
Yes.
second
Okay.
position.
They're just a lot
Yeah.
higher interest rates.
Yeah.
Yeah, so when it converts, it's a big change in payment.
Mm-hmm.
But I'm not saying the loans aren't beneficial. They
Right.
really, really are. They can be short-term loans that you need, and if you're structured enough, you can pay it off before you hit that fixed rate option.
Well, absolutely, and that's almost like a savings account, because everything is costing so much more, it makes it a little bit harder for people to put away into their savings account or into their 401k. But tapping into their equity with a HELOC, like you said, Stacy, you don't have to use it. But if, God forbid, something happens, you have the ability to go there and draw from that. So, it's also a good way to possibly use that equity to help save some money.
Yeah, or
And the
emergency.
interest rates are a lot
Right.
better than
Right.
credit cards.
Ab-
Because
amen.
credit cards are just getting worse and
30%,
worse.
exactly.
So it's
Exactly.
an
And they're
effect.
adjusting on a pretty regular basis,
Oh, yeah.
too.
25%, yeah.
Every time the Fed opens his mouth.
Much better interest rate than a credit card. And like I have one client right now that we did, we were doing our cash out refinance, but the condo was not allowable.
Warrantable.
Yeah, it had a lease on the property, so we weren't able to do that. And we went back and looked at what she was actually going to use the money for, and decided that a home equity line was going to be way better for her than just having a regular mortgage.
And they don't look at condo approval process as stringent as we do on a first
Not as
mortgage.
stringent, right?
That's
Awesome.
awesome.
Well, in summary, we just wanted to let you know that these programs are out there. We can offer them. It's just a couple of different ways that you can tap into the equity of your home or go with a lower fixed rate in the beginning, just knowing that those rates are going to adjust. Please follow us on Facebook at Mortgage Chicks with Hot Tips.
Don't forget to listen to us where you listen to all your favorite podcasts.
And if you have any questions or ideas for topics, please email us at mortgagechicks@vandykemortgage.com.
We also have a YouTube channel, Mortgage Chicks with Hot Tips.
Thanks, guys.
Thanks.